Your credit report and score, whether it's good or bad, didn't get into this state overnight. If your aim is to have excellent credit, be prepared for the long haul because improvement comes in small steps. You improve your scores with patience and good behavior over several years. But don't be discouraged. Small changes can make a big difference, just a few points at a time. Hi, I'm Roxie Dinstel, Health, Home, and Family Development Agent and Associate Director at UAF Cooperative Extension Service. How important is your credit score? If you have a score of 700 instead of 620, for example, you could save an average of $648 a year on your credit card, $1,352 on a car loan, and $2,340 on a mortgage. Your credit score is important, especially if you're getting ready for a big purchase such as a house or a car. Improving your credit before you apply for loans can even save you thousands of dollars. First, you'll want to find out where you are now. There are a few credit money management services like creditkarma.com, creditsesame.com, and mint.com that will offer you credit scores for free if you're willing to receive financial product recommendations. If you don't want advertising, you can pay $10 to $20 for your credit score from one of several online sources. It's worth it to know the score. A credit score of 760 and above is considered excellent. 660 to 759 is good, but could use some improvement. If you have a score of 659 or below, time to get working. Second, regardless of your credit score, get your credit report. From annualcreditreport.com, you can get a free annual report from one of the 3 credit tracking companies. A recent survey said that 79% of credit reports had incorrect information. 7 years of information is held on your account at any time. So look at the account with a critical eye and make sure that the information included is correct and is yours. Your information may be confused with someone with a similar name or a similar social security number, for example. Dispute any incorrect information with the online form from each company. Remember, you can't fix what you don't know about, and fixing clear errors in your credit report is the best first step to increasing your credit score. Each of the 3 credit tracking companies access different sources, so your information may be slightly different from each company. Work towards improving the information from the first report from one credit tracking company for a few months or even the full first year. Then, pull another credit report from a different company. Review the information. See what you can fix then. Beyond correcting credit report errors, the most important thing you can do to improve your credit report is to pay your bills on time. I recently worked with someone who had been a bit lax on this because of an irregular work schedule. He automated his bill paying through his bank and an online bill paying service, and over several months, the score started creeping back up. Even if your score doesn't start coming up, at least it won't decline further. Your credit utilization is another important part of your score. Your credit utilization number compares what you owe against your total credit line. You're shooting for a credit utilization of 30% or lower. So if you have a $10,000 credit card, make sure you use only $3,000 a month on that card. Even if you pay in full each month, the score is still based on what you charged before it was paid. So you might want to choose to pay more often, perhaps through a weekly automated payment instead of monthly, to keep that balance low. Also, pay off small balances, particularly if they are at higher interest rates. Limit yourself to 1 or 2 credit cards, the ones with the lowest interest rates, and charge everything on those. It's easier to keep track of. But don't close accounts that are paid off. Another part of your credit score is the age of your accounts. Long-term credit, even if it isn't currently being used, increases your credit score and is important to your credit utilization number. Let's say you have two accounts, one with a $5,000 credit line that you owe nothing on, and one with a $10,000 maximum that you owe $7,500 on. When considering both accounts, you owe $7,500 on a total of a $15,000 credit. That's a 50% utilization rate. If you close the one that you had nothing on it, you would move to a 75% utilization rate. That will decrease your credit score. Finally, if you are really concerned about your credit score, don't fall into the trap of using a credit repair company. Their fees are high, and you can do everything they can. Any money you pay a repair company decreases the amount that you can pay towards your debt. If you want some outside help, though, the Federal Trade Commission has an excellent publication on repairing your credit called Credit Repair: How to Help Yourself. There is hope. Your credit score can be improved. Know your credit score and what is on your report and take small steps to improve your score. Patience and persistence will win the day.